This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
When dealing with income tax losses back in Chapter 7, if an unincorporated trader should incur a trading loss, we saw the ways in which the loss could be relieved. Now, very simply, and just to quickly revise, that trading loss would firstly form a nil assessment in the tax year and could be offset against the total income of the current tax year and or the preceding tax year. If we didn't want to do that, or if there was more loss than there was total income to relieve against, then we could carry forward that trading loss to set off against the future trading profits of the same trade. What we also saw as an extension of the current or carryback claims, you could go against capital gains, turning what was a trading loss into a capital loss there. Added to that in the mix, we saw that there were some specialist opening year reliefs and closing year reliefs there. Now we come to corporate tax and we see a similar situation. Now, after the adjustment of profits and the computation and deduction of capital allowances, instead of ending up with a tax adjusted trading profit, bad news, we end up with a tax adjusted trading loss. What happens therefore? The assessment is nil. We never put a bracketed figure into a negative figure into a computation. This time, of course, it's the corporate tax computation. And the corporate tax computation is not prepared for a tax year, as is the income tax computation. This is prepared, as we know well, for a chargeable accounting period. So what happens as regards that loss? Well, very similar, as I say, in terms of what we did in income tax. What we saw in income tax, if you make a loss in the current tax year, you could stay where you are in that current tax year and set off against total income. You could carry back against the income of the previous year, and or you could carry forward there. So these are the directions in which we could go. As it were, this way around, we can stay where we are, we can go forward, we can go back there. And it's pretty much the same when it comes to corporate tax. The only thing that happens is we talk about chargeable accounting periods instead of tax years. So quite simply, if we have a tax adjusted trading loss, nil trading income assessment in the corporate tax computation for the period, and we can then set off against. Well, we don't now have total income, we have total profits. Remember, the company is chargeable on both its income and its gains. The company does not pay capital gains tax, it pays corporation tax on both its income and its gains. So that means that what we saw back in income tax, where we extended the current or carryback claims against capital gains, is irrelevant here because the total profits already includes that gains. So that's one style type of loss we won't have to worry about here. So in the current accounting period, we can set off against total profits. Now remember, total profits there, the sort of equivalent that we got to the total income in income tax. Total profits is before deducting any qualifying charitable donations. And that may be proved to be a problem in terms of planning as to how to get the best use out of our loss. Because we don't want to do is to waste the benefit of the tax deduction for that qualifying charitable donation. And if when we apply a loss against those total profits in that current period, we bring that total profit down to zero, then any and all qualifying charitable donations would have nothing to be offset against. And there's nothing else we can do with them. In those circumstances, they would be wasted if we're talking about a single company in that position. So a consideration as regards the best use of losses, we'll summarise these later, is to avoid wasting your qualifying charitable donations. But it's a particular problem with both the current year claim and, as we'll see in a moment, the carryback claim. So in the current accounting period against total profits, that is before the deduction of donations. If there's nothing then for the donations to go against or insufficient profit to fully utilise those donations, then any excess donations will be wasted at this point in time. Having made the claim in the current period, then and only then may you carry back. Now that loss will be carried back 12 months from the beginning of the accounting period of loss. The carryback In income tax, it was to the previous year. Now it is effectively that previous year. It's carried back 12 months. And that should routinely be against the total profits. Yet again, both current and carryback, it's total profits that we target on the carryback against total profits before the deduction of qualifying charitable donations. Now, do be aware there that here in corporate tax, if you want to carry back to the previous accounting period, 12 months back, it usually is the same as the previous accounting period. If you want to do that, then you must firstly have made the current period claim. Now, that is different to what happened for individuals in income tax. So far as an individual in income tax was concerned, if they had a loss in the current tax year, then they could claim to set off against the total income of the current tax year and or the preceding tax year. And as we often saw, it was probably the preceding tax year that was targeted. Now in corporate tax, it's different. That if we make any claim at all here, it's the current period first, and only then, if you have made the claim in the current period, may you carry back 12 months. As I keep saying, that usually equates to the previous chargeable accounting period, because you'd expect year end after year end, but the carryback period, we'll come back to it later, is 12 months. Those deductions from total profits before donations, it runs the risk, therefore, of those donations having nothing to go against if the loss has reduced those total profits below the level of the donations. Now, whether or not we've made either, when I say the current period claim or the current and carryback claim, if there's any loss left over, or as a total alternative to those two, we would then carry forward the loss. And again, here it is just like in income tax for the unincorporated trader. There's only one thing the company can set that loss off against. That's a carry forward to set off against future trading profits of the same trade. Now, those are your basic reliefs that we need to know for a trading loss. Current period, carry back, carry forward. There's no extension claims against capital gains like there was in income tax, because profits already includes those gains. Specialist reliefs. Well, there's no specialist opening years relief as there was in income tax. From the first accounting period, you can offset in that current period if you make a loss, and clearly there's nothing to carry back to. The company's only just started. It's not like in income tax, where an individual could carry the loss that they've now sadly incurred in their new business, their new trade, back against income that existed prior to the commencement of the trade. It doesn't happen in companies. In corporate tax, the company only exists from the date that it started trading. So there's no specialist opening years relief. We do, though, have a specialist closing years relief, and it's pretty much the equivalent of what we saw again in personal tax, in income tax there. It's a terminal loss relief. I just said to you that for a normal ongoing company, if it makes a loss in the current accounting period, and I use that loss in the current period, I then have access to a 1-year carryback, again against total profits. What we will see in corporate tax is any loss sustained in the last 12 months of trading is eligible for this terminal loss relief. And all it means is that instead of only going back 12 months, 1 year from the beginning of the period of loss, that with terminal loss relief, you can go back 3 years from the beginning of the period of loss. A 3-year carryback instead of a 1-year carryback. That carryback on a last in, first out basis. So if I have a loss in that final period, I can go back to the previous period, the one before that, the one before that. Goes back on a LIFO basis. Okay, now those are the trading loss reliefs that await us. And we've got an introductory note to, again, summing up some of what I have just said there. Let's have a little look at what it says. The company makes a trading loss. Let's get the pen working. Its trading income assessment for that period is nil. Again, remember, we don't put bracketed figures, we don't put negatives onto the computation. Wherever there are losses, whether it's trading or any other source, it is a nil assessment. The loss may then be relieved in the current period against total profits, followed by a 12-month carryback. Now to an earlier period or periods. I get going on about the 12-month carryback, and that should usually be the previous chargeable accounting period. Yeah, it should be, because usually it's a 12-month period, it's a year end that we prepare the corporate tax computation for. But if, for example, having made a loss in the current period, we discover that the previous chargeable accounting period was less than 12 months, which we know it could be, a change of accounting date could have occurred, for example. But if that had happened, then the carryback is 12 months. So if the previous accounting period was, say, 9 months, then we could take out all of the total profits of that 9 months, and then we would apply any remaining loss against 3 months' worth of the profit-making period prior to it. So loss-making period preceded by 9-month period, we go back against all the profits of the 9 months and 3 months of the profit period prior to that. It's a 12-month carryback. And again, of course, we'll have an example that tests out that system later on in this chapter. As we said, carryback against total profits as well as the current period. Total profits is the target figure. And all thereby carry forward to relieve against future trading profits of the same trade. There's a choice, therefore, about the loss reliefs that we make. So in making that choice, we need to know what objectives are we striving to achieve? How do we get the best use out of those losses? It's an important planning issue and something that the company would need to consider. So we're told, as all companies now pay corporation tax at the same rate of 20%, the choice of loss relief will now be based on, well, once upon a time when tax rates were different, there was clearly a main objective. Let's try to put the loss against the profits being taxed at the highest tax rates. Doesn't happen now for us. Life is simple at this point in time. It's just all 20%. So what then becomes our objectives? Based on achieving relief at the earliest available opportunity. Now then, we've said about for a normal ongoing business, we have current period, carryback, carry forward options. There we go, we have an objective here, earliest available opportunity. So you think for a moment, given what I've told you so far, about the order of set-off. If a question said, here are the relevant accounting periods and here is your loss. And they want you to claim relief at the earliest available opportunity. In terms of the 3 main reliefs that I've made reference to, current period, carryback, carry forward, what would be the order in which you would apply those losses? What would that order be? Now, the first temptation would think earliest relief is the previous period. If you can carry back to a period for which you've already paid the tax, then you'll get a repayment of the tax that you paid. The loss goes against a profit. You've already paid the tax on the earlier profit. Now it transpires that you shouldn't have done because the loss has reduced, if not removed, that earlier profit, so you get your money back. You get a repayment of the tax you paid. Well, that's better than using the loss in the current period, which would simply reduce this year's payment. And it's certainly better than relieving in a carry forward situation where you go forward against the future trading profits and you would only gain any tangible tax relief for that loss when future tax charges would become payable. So from a cash flow perspective, we want to carry back. But remember, we have a problem in corporate tax. In corporate tax, you cannot carry back unless you have firstly relieved in the current period. So in order to follow that idea of giving earliest available relief, the order in which the losses would have to be applied would be current period, carry back, and then carry forward. So when a question says for you to show the loss reliefs, assuming that you relieve the losses at the earliest available opportunity, the order for making those loss relief claims is current period, carry back claim, carry forward. Now that's an instruction that you need to understand and be able to obey. Again, we'll look at the detailed computations in a few minutes' time. So there's one objective. Again, it's down to cash flow. If we could get a repayment of tax, that is better than a carry forward of the loss to the future, whereby you'd have to wait until you gained any cash flow benefit. So cash flow, earliest relief. Also, to do with cash flow, we'd like to use our losses to avoid making quarterly instalment payments. That's a trickier one to get our heads around. Now, we don't yet know, and we won't until chapter 23, exactly how the quarterly instalment payment system works. But it means you are paying tax sooner rather than later. You don't want to do that. So if you could avoid quarterly instalment payments rather than paying sooner, you'd pay under the normal system 9 months and 1 day after the end of the accounting period. Now, what would cause the company to have to make those quarterly instalment payments? Well, if you recall from our first introduction to corporate tax in chapter 16, what we saw there was that if the profits as defined, TTP plus dividend income, if the profits exceeded the profit limit, on that basis the company would said to be large, and then quarterly instalment payments may become payable. So what makes a company large? If its profits, TTP plus dividend, there exceeds the profit limit. So if we had a company, therefore, that for a period its profits were above that profit limit of 1.5 million, if we could use a loss to reduce those profits down below the profit limit, that would remove any requirement to make quarterly instalment payments and therefore give us a serious tax advantage. Now again, we'll talk more about the details of that when we deal with quarterly instalment payments in chapter 23. All you've got to be aware of here and able to deal with, should you get, for example, in section 3, constructed response or written question there, you might get a question dealing on your corporate tax question, dealing with corporate tax losses, and as well as dealing with the numbers, you've got to identify what objectives would you have to get the best use out of the losses. That's what we're dealing with now. This is the basis of your answer for 2 or 3 marks, very easy marks indeed there to secure. So avoid making quarterly instalment payments and also seek to avoid wasting relief for qualifying charitable donations. And the reason why we have a particular problem here is both the current and the carryback claims target total profits. Total profits, not taxable total profits, and therefore it's before the deduction of the donations, which, as we said, because you cannot make partial claims on your current and carryback or indeed carry forward claims, if you make a claim and it reduces the total profit down below the level of the donation paid, then that donation paid is wasted to the extent there that you can't use it. There's no ability to carry it forward or carry it back. It will be wasted. Okay. Spend a lot of time on that introductory paragraph there because trading losses are the main area that we're going to be involved with. And hopefully we've understood the statements that we've made there. Then the principles become a whole lot simpler. And all we then got to do is to see how do we present this information, what's the computational base that we will use, and the technique then becomes very straightforward. The principles are in essence here straightforward. So it's not something, not an area that you should be afraid of. It's an area that you should actually want to come up. Because as long as we construct, we present our answer properly, that's always true, I suppose, but it's a very simple way. As long as we do that, so many of the marks, so much of your answer is just copying information straight from the question, but in the answer format, and then applying the basic principles I've already outlined. Before we go into the detail, therefore, of those trading losses, just a quick note about the fact that here, for corporate tax, there's a couple of other types of loss that we may have to deal with, and they're very much quicker and easier to deal with. What we've got is one that we've already mentioned back in chapter 16, property business losses. Yeah, if on property income we have more expenses than we have income, then we end up with a loss. And we've already made the point, what will happen to that loss? Now it's noted here, but I hope that you may recall it anyway from what we previously said. That loss would firstly be set off against the total profits of the current period. And that automatically happens. It goes against the total profits of the current period, and that relief, if necessary, would apply before any trading loss relief, though it's unlikely that you would have both in the same period. So against the total profits of the current period, now the probability is that that loss will be much less than the total profits of the current period, and that'll be it, job done. But if we had more loss than there were total profits in the current period, then, you would be able to, and you would, carry forward that excess property loss to go against the total profits of future accounting periods. And it will go against the next available total profit figure. Capital losses, well, to an extent we've seen this, because what we already know is for the corporate tax com for the current chargeable accounting period, what we must do is to net off any capital losses against the chargeable gains of the period. What we haven't yet considered, though we've seen the issue in income tax, or personal tax, I should say, for CGT. But here, if there's a net loss for the current period, then we can only carry forward those net capital losses. No carryback. Carry forward against future net chargeable gains. Again, doesn't go against income, only goes against future net chargeable gains there. And that's the information there. All right. It is therefore these trading losses that are going to occupy most of our attention, most, if not all, of the marks in terms of any examination question. And I said to you, it was about structure of your answer, laying the information out. Now again here, we firstly got current period relief. Now the chances are in any exam question, you're not going to be presented with just the information for one period, the current period. You would have probably at least one, if not two periods prior to it, so earlier accounting periods, and maybe even projected figures for the next period. Basic to test out your awareness and ability to apply loss reliefs in the current claim, current period, carry back claims, carry forward claims. So it's usual to see 2, maybe even 3 or 4 accounting periods of information provided. So what we've got to do is to prepare our answers for these accounting periods in a columnar basis. Now here, there is only one period. It's the accounting year ended 31st of March 17. If you were dealing with more than one accounting period, then you'd have a column for each such accounting period here on the right-hand side of your page. So put it into columnar form. Do not go down the page accounting period by accounting period. Have all 2, 3, 4, however many accounting periods there may be, in front of you there. So what we're able to do is to put down the income and eventually use of any losses for each of these periods, but we can see everything in one go. So a columnar form, please, where we're dealing with multiple accounting periods. Not an issue here. There's only one period. So it's very simple. I said about copying down, right? We're told in the question that for this period, there was a trading loss. So do we put 45,000 with brackets round it in here? No, of course we don't. That means that your trading income assessment is nil. We then include our other income. We've got interest income. And of course, we include any chargeable gains. And they are respectively 20,000 and how much is that? 50,000. Added up, we've therefore got total profits of £70,000. Now it would be away from total profits that you would be deducting, of course, where's that gone? Your qualifying charitable donations. But before we deduct those qualifying charitable donations, it is in here now that we show the deduction of the loss relief. So less our current period relief. How much was the loss? The loss was £45,000. Now here, if the loss was more than £70,000, then the whole £70,000 would be eliminated. You'd bring the total profits down to nil, and if there was still excess loss remaining, you then had the choice between, do I carry back now or do I carry forward? Here though, just £45,000 worth of loss. That therefore leaves us with, after the loss relief, a revised total profit of what would appear to be £25,000. Thankfully here, sufficient to absorb all of the qualifying charitable donations of £15,000. So none of those have been wasted. As I said, if the loss here had been bigger than 70,000, the figure there would be nil, and all of the £15,000 donation would have been wasted. Now, of course, during the accounting period, your accounting information should have been such as to tell you you're going to be making a loss. It's hardly a clever time to be making a donation to a charity, therefore. Now, although it's therefore unlikely in real life that you'd see that happening, in exam questions, happens all the time. So be aware that our current period relief is applied before donations. Take away the donations, and that still leaves you with some £10,000 there of TTP, your bottom line TTP. So there you go, your current period claim. All you've had to do is put nil in as trading income, list out the other amounts chargeable, get your total profit figure, and then, take away your current period relief. Here, all of the loss was consumed because the total profits were bigger than that figure. It also meant that the 25,000 that remained was big enough to absorb the donations. If it were not, any excess donations wasted. You lose them. You don't get to carry them back or carry them forward. If you can't use them in this period, you're not going to be able to use them at all. They'll be wasted. Okay, so there, nice simple current period relief. If, of course, you'd made a current period claim, and after so doing, there was still less loss left over, then, of course, you have the option to have your carryback relief. Now, again, what do we say it would go against? Exactly the same as in the current period. It goes against total profits before the deduction of the qualifying charitable donations there. So, having first relieved the trading loss in the accounting period of loss, only then, remember, you must make the current period claim first. Only then can any remaining trading losses be carried back, and again it's against total profits, which we know is before the donations are deducted. And it's a carryback for the preceding 12 months. It's a 12-month carryback. Now, routinely, as you'll see in example 2 coming up, the 12-month carryback means it goes against the previous chargeable accounting period, because you'd expect it to be 12 months in duration. One point here, it doesn't matter how long the loss-making period is. If it was a 6-month loss-making period, then still the carryback would be against the profits of the previous 12 months there. It's a 12-month carryback, however long the period of loss may be. The loss must be applied fully against the available profits. Remember, partial claims not available. We'd like to be able to do it in order not to waste those qualifying charitable donations. But don't even think of it, you can't, they're not allowed. These claims may therefore result in no tax relief being achieved for the donations. That was one of our objectives, so it's something that we have to bear in mind. With current and carryback claims going against total profits, that means it runs the risk of wasting those donations. Something, of course, that we would not wish to happen. Okay, let's have a little look now then at example 2, where we've got more than one period to deal with. Now, what we're required to do is to show how the loss relief would be claimed, assuming that loss relief is taken as soon as possible at the earliest available opportunity. We have 3 accounting periods mentioned here. All the years ended the 31st of March. And our loss-making period is the last of these, the year ended March 17, where we can see a trading loss of £90,000. Now we know what the order of loss relief usage would be. In order to get relief as soon as possible, you go with a current period claim, because you have to if you want to carry back. Then you go with a carryback claim. How far back would you go? 12 months. So you can only go back to the year ended March 16. So anything before that, like the 2015 period here, can't be touched. You can't change those earlier profit figures. So we've got current and carryback claims. If there were any loss left over after that, then it's carried forward against the future trading profits of the same trade. So what have we got here? Let's just show what we need to show what's going to be affected by the loss. We have got year's end 31st of March, and we've got 2016 and 2017. Pick, of course, first. Again, we said it's just writing stuff in for the question. Trading income, year ended March 16, was £60,000. We had the loss for the year ended March 17, so that is a nil assessment. Do we have any other income? Yeah, we've got some interest receivable, some interest income here. We might have some property income, we might have some capital gains. Any and all would be shown at this point and included. That would then give us the total profits for each of these 2 periods, and then you could apply loss reliefs before, remember, deducting, if possible, any other qualifying charitable donations. Here, of course, this is the only other item to deal with, the interest income, and it's £10,000 in each such period. So our total profits here will be 70,000, 10,000. Relief at the earliest available opportunity means current period relief. Again, just to remind you, I know that earliest relief would be to carry back. Earlier is better, but we can't carry back unless we've gone through the current period first. So the current period relief would be 10,000 and therefore eliminate all of those that interest income there, all of the total profits. It would mean, of course, that had we made any qualifying charitable donations for the period, we didn't here, but had we have done so, those donation payments would have been wasted, i.e. no tax relief would be available for them. Having made the current period claim, we can then do our carryback claim. Now the loss was 90,000, we've used 10,000, we have 80,000, so there's enough to take out all of that 70,000. Now, when things start to get just a little bit busier and there's a lot more information, what you might find it useful to do here, as well as your columnar presentation for each accounting period, where you show the loss reliefs, the current period, the carryback, and if necessary, the carry forward. What you might also want is a little working, let's say working 1, a little loss memorandum, column there, where what you would have is the loss-making period, year ended March. What was it? Was it year ended March? Let me just check. Yeah, year ended March 2017. Year ended March 17, and it was a loss of £90,000. We then keep a record of how it's used. We had our current period relief. That was 10,000. We then have our carryback relief. That was 70,000, meaning at that point we've used 80 out of 90. There is therefore £10,000 remaining. What is the only thing now that we could do with that 10,000? We've done the current period, we've done the carryback claim, so all that's left is the carry forward. And the carry forward, of course, goes against, what was it? Carry forward against future trading profits. So as and when you have future trading income or future trading profit, it will automatically go against that next one. The first possibility, of course, for that, this being the loss-making period of the year ending 31st of March 17, that would be the year ending 31st of March 18. So two parts to your answer, therefore. Firstly, the columnar approach here, a column for each accounting period, taking the information from the question and putting it into this format. All you're doing there is copy information out, but if there's a loss, we put a nil assessment in its place there. Get down to total profits, make it current, make it carry back claims, anything left over is carried forward, but show how that loss is being used, as we see here, in the form of a loss memorandum. Thank you very much, job done. Okay. What I need you to do now is to, of course, work through the examples that we have just done, make sure that you are happy with them. And what you can then have a go at before I see you next, and I'll take you through this, is a more interesting example 3 that you see here. Now, what is it that makes this example more interesting? So remember, what do we need to do? They're asking us to assume relief is taken at the earliest opportunity as soon as possible, and there is your loss-making period for the year ended December 16. Where will we use it first? Against other profits, total profits of the period. We've got bank interest, we have got chargeable gains there. Now that means that the first relief will be the £1,000, the bank interest. That will have the effect of wasting those donations because now there's nothing left to go against them. So of that loss, it will be a nil assessment, of course, in your answer. We'll use 1,000. Now that means that you can then carry back, once you've made the current period claim, it accesses the carry back claim. You'll have used 1,000 out of 40, you've got 39 to carry back. What does it go against? Total profits. Now, what I've done here in this question is to make life just a little bit more interesting, because the previous period is only 9 months, and you know the carryback is 12 months. So once you've relieved against the 9-month period, we've then got 3 months worth of the period prior to it, where the relief will also be applied. And rather than just having one type of loss, the trading loss, I've also put in another loss, sneakily here, the capital loss that needs to be dealt with again on this columnar basis on our presented answer. Now what happens if you have net capital losses for the period? There's only one thing you can do with them, carry them, which way? Forward. Carry them forward. So before ever you got to this loss-making period here, the previous period, what would have happened? You had a gain of 6,000, you made a loss of 1,000. So that 1,000 will have gone against the 6,000, bringing it down to £5,000. Now you have to be aware of that and you have to deal with it. If you've got more than one loss within the example, such as here, always deal with the first loss first. Again, at the end of the 9 months to December 15, you did not know that the next accounting period would generate that trading loss. What you did know is you made a capital gain of 6,000 and you had a brought forward capital loss of 1,000, which would therefore go against it. So that would be in the computation. So when you then show your answer, you're going to have columns for each 3 of these periods. You're going to have nil assessments going in where there are losses. You need to therefore show a working that reduces that 6,000 by 1,000, the capital loss brought forward, down to 5, and then go down to total profit and leave a gap before any donations are deducted, into which the carryback relief claim can be made. Where would you go? Current period, carryback. Well, what would we have there? 20,000, another £1,000 of interest income. That capital gain would have gone down to 5,000. So we would have therefore 20 plus 1 plus 5 is 26,000. We had £39,000 worth of loss left over from the 40, having relieved in the current period. So all of those profits would go. Again, the donations would be wasted, and then you could go back against 3 months worth of this period. In this period, what would the total profits have been? The capital loss was nil assessment, 25,000 plus 3. So 3 months of that will be eligible for loss relief. Now, I'm going to give a big ask here to see whether you can apply what we've done so far on a fairly simple basis against this, or in this problem, which is much more of an examination standard. But see if you can do it. If you can do it, you'll be the stronger for it. Don't worry if you get into problems, because at the beginning of the next session, I'm going to take you through that. So I look forward, therefore, to seeing you in our next session together, where we continue with our study of these corporation tax losses, where hopefully at least you've had a go at this example 3. As I say, first thing I'll do, I'll run you through the answers before we then move on to deal with the other aspects of these loss reliefs and applications of the reliefs that you need to know about. Again, I look forward to seeing you then.